Which should you own in your portfolio now? Joining us now to make the case for Walmart is Greg Melich, equity analyst with Evercore ISI. He lists Walmart as one of his top 5 picks. And to make the case for Target is Chuck Grom, an equity analyst with Gordon Haskett. He just upgraded Target a couple of weeks ago and highlights it as one of his top ideas for the year. Mr. Grom, welcome. Good to have you with us. It's not that you don't like Walmart. It's just that you like Target a little better. And if I'm reading my notes right, see an implied return of about 12% in that stock. What is it about Walmart? What is it that you like about Walmart?
Well, I like both of them, actually. So first of all, Greg, please take it easy on me, if you will, in this bull fight. I do like Target. Target's significantly underperformed over the past 18 months, whereas Walmart's up over close to 25%. Costco's up 60%. Target trades at 14 times. And to your point earlier, it's significantly underperformed. And when we look ahead, we think there's going to be some mean reversion within the general merchandise category. And in fact, I think we've already started to see some signs of that over the past couple of months from Costco, who's called out an improvement in discretionary. Even this morning, Walmart talked about an improvement in unit demand. And so first of all, I think that the big thing for us is we think the general merchandise category is stabilizing. And as we progress throughout 24, we'll start to improve. And that really is the big reason we upgraded the stock a couple weeks ago, to your point.
So, Greg, let's I don't want you to beat up on Chuck there. He asked for your mercy, but let's move to why you favor Walmart over Target today.
Yeah, so again, Chuck, don't beat up on me too much either, because we also think Target can be worth more than it is today in 12 months' time. But the reason we favor Walmart, and has since we upgraded really last March, was we think for the first time in almost a decade, they've got real retail momentum driving traffic growth. And with that value proposition driving traffic growth, that gives them the opportunity to unlock margins in a lot of different areas. It could be through the advertising business. It could be through 3P. And critically, it could also be through taking out cost, which they talked about again today on their call as they automate more of their regional DCs. That could be 100 bips of margin potential over the next few years. So to us, Walmart is in the early innings of a multi-year reacceleration of not just sales growth and traffic growth, but really profit growth. And that's why, yes, it is more expensive. It's around 24 times next year numbers. But once you back out Flipkart and Sam's Club, it's some sort of evaluation discount to Costco. We think Walmart US is trading at under 20 times, and that's a pretty attractive valuation for an asset of that quality.
So give me quick thoughts on two things. One is Walmart as an advertising player, something I wasn't really deeply aware of. And number two, Walmart and its deal for Vizio. How do they factor in?
Well, we're restricted on the Vizio deal, so I won't speak to that. But to answer your question, bigger picture on advertising, we look at Amazon and we look at them taking advertising revenues up to about 5 or 6% of GMV, which is a 30% margin plus business. And if we look at Walmart now with 100 billion of digital revenues, just getting to that Amazon type penetration could get you to 5 or 6 billion with that higher margin. So it's the kind of thing that it's not going to be massive right now. It may only be 10, 15 bips of tailwind, but as it starts to scale and grow, and again, there are different ways to do that. Vizio is one other way, but as you scale that business, we think it's a real tailwind to Walmart that, frankly, a lot of other retailers don't have.
Back to you, Chuck, with some thoughts on Target. I note in my notes that you cite spring weather, easing inflationary pressure, discretionary recovery, and margins as all reasons that Target may get some benefit here. Couldn't you say the same thing about Walmart, though?
Yeah, unequivocally. I mean, I think like I said, we're buy rated on Walmart. We have a 190 price target on it. We upgraded it a couple of years ago. I think it's in this environment where there's still uncertainty. It's important to be barbelled and to have Walmart on one side of that barbell and Target on the other. And to your point on the margin front, there's very few retailers that today whose operating margins are a couple hundred basis points below where they were several years ago. And because of shrink, because of mix, because of digital, Target's operating margins this year are going to finish close to 5. We think over the next couple of years it could get to 6. That gets you, $9 to $10 in earnings power, which really has got tremendous upside to this stock right here. We agree with Greg. I like Walmart a lot for all the reasons he said. I think it's a great long-term holding. I just think Target's got a little bit more juice here in the next 6 to 8 months right now, if we're right on general merchandise recovering.
All right, gentlemen, the case has been made. You've made it well. We appreciate your time today, Greg Melich and Chuck Grom. Thanks.
Thank you.